The introduction of tariffs has become a frequent topic of discussion. As of April 2nd, President Trump issued an executive order implementing broad tariffs, which have undergone several delays and adjustments before finally taking effect. According to reports, these tariffs will apply a 15% rate to most countries, although nations like India might face even higher import taxes. In fact, the U.S. has now imposed the highest tariff level since 1933. With an average tariff rate of 18.6%, as calculated by the Budget Lab at Yale. This new era of tariffs raises numerous questions about its impact on the U.S. economy and everyday consumers. One of the most common inquiries is whether prices will increase. Economists generally agree that the cost of tariffs will be distributed among overseas exporters, U.S. importers, and ultimately, consumers. While some companies, like General Motors, have absorbed initial tariff costs to protect their profits, this strategy cannot continue indefinitely. Eventually, these companies will need to negotiate with foreign suppliers to share the burden, leading to higher prices for goods. Another frequently asked question revolves around the extent of price increases. The Budget Lab at Yale projects that certain categories, such as clothing and textiles, could see significant price hikes, with shoe prices potentially increasing by 39%. However, predicting exact price changes for specific products is challenging due to the distribution of tariff costs among various stakeholders and retailers' pricing strategies. The Budget Lab estimates that the average household might incur an additional $2,400 in costs this year due to tariffs, but this is based on current information and may vary. Despite the anticipated rise in prices, overall inflation is expected to increase modestly. Consumer prices climbed 2.7% in July compared to the previous year, marking a larger increase than in recent months. While economists anticipate further inflation due to tariffs, the rate is projected to remain well below the peak of 9.1% observed in 2022. The concern lies in how inflation affects public sentiment and consumer behavior. Raphael Bostic, president of the Atlanta Federal Reserve, noted that inflation tends to dominate headlines, potentially influencing people's spending habits and business strategies. Tariffs may also have implications for employment. Job growth in July was notably weak, with only 73,000 new positions added to the economy. This contrasts sharply with the robust job market seen in previous years. Although the unemployment rate remained relatively low at 4.2%, economists predict that hiring will slow as companies grapple with higher tariff costs and adopt more cautious investment strategies. Signs of difficulty in securing new jobs, particularly among recent graduates, suggest that the labor market could worsen further. Lastly, while these factors raise concerns about economic growth, most economists do not foresee a recession. Surveys, such as one conducted by the Wall Street Journal, indicate a lower risk of recession, despite expectations of slower economic activity. Stock markets have shown resilience, with indices like the S&P 500 and NASDAQ reaching record highs as investors remain optimistic about the U.S. economy's ability to withstand the impact of tariffs. Nonetheless, the effects of tariffs will be felt across businesses and households, underscoring the need for careful monitoring and adaptation.